And so I think this is a big bull market. Silver is still around $46, $47. Yes, it's below the $54 that it hit a couple of weeks ago, but it's way above where it was a month ago. It's way above where it started the year. So I think it's just, the trends are intact. We shook out some of the, the new, buyers that, really, were leveraged or don't really have, belief in the trade. So the weak hands maybe have folded already. And we worked off an extremely overbought condition. Gold was as overbought as it's ever been. And so that's not the case anymore. And we got this correction out of the way, and we're still at 3,900.
Gold's recent pullback rattled some traders, but Peter Schiff says it's not the start of a decline. It's just part of a bigger climb. After an explosive rally that sent prices near $4,400, gold corrected hard, dropping about 6.5% in a single session. Schiff calls that move a natural shakeout in an overheated market. Prices have since stabilized above $3,900, which, he reminds, is still a record compared to where gold stood even a month ago. In his view, what just happened is classic bull market behavior. When momentum builds too quickly, short-term traders pile in, many using leverage and tight stops. A sharp dip like this flushes out those weaker hands, setting up a stronger foundation for the next leg higher. Schiff points out that support appears to be forming near $4,000, much like how the $3,000 level acted as a floor earlier in the year before gold surged to new highs. Silver, he adds, is following the same script, down slightly from recent peaks but holding strong around $46 to $47. Both metals are still in clear uptrends. Schiff argues that the real story isn't about gold's price swings at all, it's about the dollar. The dollar index's brief rebound above 100 doesn't impress him. He sees it as a temporary pause in a longer decline. Gold holding near $4,000 isn't coincidence, it's a message. The market is signaling deep structural problems in the U.S. currency and debt markets. Investors, he says, are starting to hedge against that by buying gold, not for short-term gains, but for protection against what the dollar's next move could mean. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Well, I think it's very, interesting that a lot of people are describing gold being in a slump. Gold is above 3,900. A month ago, that's an all-time record high, right? A few months ago, if you'd have told anybody that gold would be at 3,900 and change in November, they'd have been, no way, it's not going to get up that high. All we did is we went a little bit too far, too fast. Gold got extended up to almost 4,400 and then had a sharp couple of day pullback. But gold is in a powerful uptrend. This is a massive bull market. And it's classic that you have this sharp decline. Almost all of the decline was one day, right? We had a 6.5% drop in a single day. It's gone down a little bit since then, but that was the lion's share of it. And it scared people, mainly the people who, got in recently because they saw gold going up every day and figured, well, let me just hop on board. It's going to be a smooth ride. And then they got a big drop. And obviously some people might have been cute. They might have used leverage. Maybe they were in the futures markets. Maybe they had some stops and they got ran. And so, but the psychology, even here, we're at this gold conference and the mood is not nearly as, exuberant as I would have expected. A lot of people are a little nervous, taking profits on their gold and on their gold stocks. The opposite of the Bitcoin conference that I was at in over the summer, where there were 35,000 people, right? We don't even have 1,000 people here. Yeah. There are 35,000 people, and everybody was optimistic. There was nobody that thought Bitcoin could go down. Everybody thought the sky's the limit, we're going to the moon, 1 million, 10 million, bet the farm, mortgage the house, put everything in Bitcoin, right? That's enthusiasm, right? Here, it's skepticism, it's fear. People, yes, they're bullish, but they're nervous, and so I think this is a big bull market. Silver is still around $46, $47. Yes, it's below the $54 that it hit a couple of weeks ago, but it's way above where it was a month ago. It's way above where it started the year. So I think it's just, the trends are intact. We shook out some of the, the new, buyers that, really, were leveraged or don't really have, belief in the trade. So the weak hands maybe have folded already. And we worked off an extremely overbought condition. Gold was as overbought as it's ever been. And so that's not the case anymore. And we got this correction out of the way, and we're still at 3,900 because we went up so far so fast, we were able to have a correction, yet, we're really correcting to 4,000. I think 4,000 is about the support. Even though we're below it, it's like 3,000 was support. When we first broke above 3,000, we had several trips back down to 2,900, and then we took off for good. And I think we're doing now around 4,000 what we did earlier at 3,000. Yeah, I mean, the dollar index back above 100 today, but I think the dollar's headed a lot lower. And I think that's one of the things that $4,000 gold is telling you. It is a warning that there's a problem for the dollar. That's why so many people are buying gold.
Peter Schiff says investors are finally catching on to something gold advocates have known for years. Gold has quietly outperformed stocks over the past quarter century. The metal's role is shifting again, not just as a hedge but as a long-term store of value. Central banks continue to buy at record levels, reducing their dependence on the dollar and rebuilding trust in gold as a monetary anchor. Now, institutional investors are beginning to follow the same trail. For gold miners, Schiff says the setup couldn't be much better. Even if gold were to retreat toward $3,000, which seems unlikely with current momentum, production costs for most major miners hover around $1,400 to $1,500 per ounce. That means they're still making enormous profits. The key difference today is that costs aren't rising as quickly as gold prices, so margins are expanding instead of getting squeezed. With strong cash flow, many miners are flush with capital. Schiff expects the next stage of the bull market to bring consolidation, large producers snapping up smaller ones rather than spending years and millions on new exploration. That kind of merger activity could redefine the sector, rewarding efficient operators and setting up the next leg of the gold cycle. Let's get back to the interview.
More investors are waking up to the reality that, gold has outperformed stocks for the past 25 years. That the thesis behind gold, the investment thesis, is stronger than ever. Central banks are committed buyers. They're de-dollarizing. They're moving off the dollar standard back to the gold standard. They're going to keep buying gold. Institutions have finally discovered gold. So it's a great story. And the gold mining companies, gold's not going back down below 3,000. Right? It's not going to get much below 4,000. But even if you think it could fall to 3,000, 3,000 is a great price for these mining companies because their cost of gold maybe $1,400, $1,500 an ounce. Yeah. That's huge profit margin. There's very few businesses that have margins that high. Yeah. And that's with the price of gold falling. But what if the price of gold just keeps rising? Right? The problem for a while for the miners was that even though the price of gold was rising, the cost of mining it was rising faster. Now, it's the opposite. Gold prices are rising much faster than production costs. And so these companies are going to be making a fortune. And that also means a lot of these companies are going to get bought up because the big companies are cash machines now. And what they're going to be looking for is how do we replace our reserves that we're mining? We can either launch some exploration projects and roll the dice or just buy up some reserves from some of these cheap companies that they're publicly traded. We could just buy them up. And that's what's going to happen. Warning about this since they started. These Bitcoin ETFs, right? Everybody loved them on the way up. But when you get mass liquidation from the ETFs, because the ETF buyers are not diehard Bitcoin maxis. I mean, after all, if they were, they wouldn't own ETFs. They'd own their own Bitcoin. These are just traders or regular investors who bought these ETFs because they were going up and because they were hyped and promoted, and people thought, hey, I'll buy this and I'll make some money. Well, when they see that they're down 20, 30, 40, 50%, people are going to say, I had enough. I'm going to cut my losses and I'm going to move my chips to something else. Well, I think that that's going to happen en masse. I think you're going to see, a year worth of buys liquidated over 1 or 2 days. And the question is, who is going to buy all that Bitcoin? We know who sold them all the Bitcoin. Those are all the whales, the OGs that had all the Bitcoin to cash out. But who's going to step up to the plate and buy that Bitcoin? And by the way, if you go back and look at a lot of the big Bitcoin crashes, all of a sudden there's a bunch of new tethers that come out of nowhere and buy up Bitcoin, right? And people are like, wow, they just counterfeiting these tethers and using tether kind of like the Fed, like to prop up the market. Well, when the ETFs sell, you can't buy with tether because the ETFs can't stick tether into the brokerage account of their customers. So they're going to have real dollars. So you're going to have actual buyers, not fake tether buyers, but real people are going to have to step up and catch that falling knife and say, oh, I'll buy that Bitcoin. I don't think they exist. Maybe there'll be some pressure by the Bitcoin community on Trump to get the U.S. government to bail out Bitcoin, right, to fill up the strategic reserve. But that would be real desperation if taxpayers had to come and bail out Bitcoin, especially when Trump's family is completely invested. It'd like to be a bailout for his own family to use taxpayer money to buy up, Bitcoin. But it would also, the fact that the government needs to bail out Bitcoin proves that the whole thing is BS. It's not a strategic asset. It's not digital gold.
Something remarkable is happening in the precious metals market that goes beyond short-term price action. The recent dip in gold wasn't a sign of weakness. It was the kind of pause that strong trends need to catch their breath. Every sell-off in this cycle seems to reveal the same truth. Demand isn't fading, it's deepening. Central banks are locking away more bullion, miners are generating record profits, and investors who once saw gold as a last resort are now treating it as a first line of defense. Even silver's steadiness hints at a broader recalibration of value, where tangible assets are quietly reclaiming the trust that paper markets have eroded. The dollar's fleeting rebounds no longer convince anyone that the structural imbalances are fixed. They only highlight how fragile confidence has become. What this environment suggests is a slow but undeniable shift in global priorities, from speculative growth to real preservation of wealth. The story isn't about volatility anymore, it's about credibility, and gold seems to be winning that argument one correction at a time. If this quiet revaluation continues, will the next major rally in gold mark not just a new price record, but the moment when faith in fiat currencies finally gives way to something far older and harder to manipulate? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.